Good evening, everyone. Thank you for spending the day with us today. Very quickly, from an Axis Bank, where is Axis Bank today? Axis Bank today is a stronger, more consistent and sustainable franchise than you have ever seen before. And when we say Axis Bank is a stronger franchise, we just don't mean stronger by virtue of the financial performance that it is demonstrating, but stronger by virtue of product capabilities, depth of bench talent, depth of product innovation, depth of technology, a lot of which you've got a flavor of in the early part of the day today. Axis Bank is also more consistent. When we say consistent, it's consistent in terms of how we view our strategy, the fact that we have consistently built and invested in the entire technology backbone, our analytics team, our digital team, to create a new, stronger bank for the future. And sustainable, we haven't taken any actions in the short term. You would have seen some of that play through in terms of the investments we are making, and also what we are doing on the financial side on prudence, what we're doing on the risk side in terms of risk governance and underwriting, demonstrate the fact that we are today building a sustainable, consistent and sustainable franchise. Well, the classical safe harbor. Well, if you look at where we are today from a financials perspective, we have a strong balance sheet. We have demonstrated significant improvement in the quality of our earnings, and there is clearly visible and consistent delivery that is playing through Axis Bank. Important to look at this slide. We are getting self-sufficient on capital to fund future growth. It's exceedingly important if you look at where our balance sheet metric is, and I'll take a couple of minutes to explain this. If you look at 5 years from March 17 to March 22, as a franchise, we consumed 514 basis points of CET1 capital, against which we accreted 338 basis points of CET1 capital. And consequently, in order to get our CET1 levels to 15.24, we ended up raising 5.87, and we did come to the market on multiple occasions to get that level. If you look at where we are on return metrics, our profit accretion is sufficient to fund future growth as we stand today, just in terms of CET1 numbers. 1.09% CET1 is what we've accreted in the first half of the year. We've consumed 118 basis points of CET1, of which 11 was a regulatory change. So if I net down the 11, we are well on our way of being self-sufficient on capital. Apart from being self-sufficient on capital, we have also got to realize that we have significant balance sheet buffers in place. If you look at where we started our journey, our CET1 had a cushion of 3.9% over regulatory minimum. Today we are operating at close to 7.25. On a cumulative capital basis, 7% plus. If you look at accretion of CET1, and we do appreciate that absolute levels of CET1 are important, but if you look at accretion of CET1, over a period of 19 to 22, we've accreted 390 basis points of CET1, and some of our private sector peers, the numbers are up there for you to look at. The standard asset provision cover is 1.6, gives us sufficient balance sheet cushion apart from 55 basis points of capital that is set aside in COVID provisions, not counted towards capital. Asset quality for us is a done issue. If you look at every qualitative metric, and I'm not going to run through the slide, I'll just request you to look at the two panels on the extreme left-hand side of this slide. The gross slippages, we've seen a lot of conversations today on Axis moving to unsecured business on a relative basis, Axis changing its product proposition and profile. What I just request you to have a look at is, when we say we are keeping our guardrails intact, you can look at the gross slippages number, and that will indicate to you the quality of the book that we are building. More importantly, if we benchmark portfolio performance, especially on the unsecured products, you will see that we are doing at or better than industry by a margin. NIMs. Our NIMs have shown a consistent improvement despite reduction in risk on book. And when we see risk on book, we are saying risk on book by virtue of RWA intensity. Further, the one point I would like to leave behind with you is the fact that we embarked on a journey to structurally improve our NIMs. It was a 5-plank journey. We still believe that we have legs on those planks to deliver further improvement, which in our mind, should cushion any deposit cost increases that we may see. When I say consistency, I would request you to go through this slide. I'm not going to touch each panel, but look at consistent execution on strategy. We said we will get the book to be more granular, 63% to 69%. We said that we would reduce RIDF share down by 10,000 crores. We said we would focus on average CASA. We're not focused on building period end balances. The average CASA is up by 400 basis points over a 3-year period. Fees. This is reflective of quality of the earnings that we are building through time. So fee to assets moving up, retail fees in the total fee composition moving up by close to 300 basis points. But more importantly, on the wholesale fee, one of the things that we heard through the day is the wholesale franchise on the loan book side was growing slower. But I request the audience to look at the granular transaction banking fee. That reflects saliency of customer relationships, and there you will see that we moved up by 800 basis points in terms of fee share. The quality of earnings of this franchise. If you look at the period pre-March 19, close to 91% of our earnings were fee plus interest income. Effectively, 9% of our income came through trading income. If you look at it from post-19 to now, 96% of our income is coming from fee plus net interest income, which means it's sticky, hardcore business-led fee. Costs, and I'll spend a few minutes on this slide because I know there were a lot of questions on this through the day. Let's look through our cost journey. We started investing in the business in FY21 all the way up to FY20, end of FY22. So that's the investment phase of our journey. And where did our investments go? Our investments broadly went in growing our business and in technology and digital. So at the bottom left-hand side, you will see close to 62% of our investments is tech and pure growth business led. And that's where the money that's being spent is going to. But it's equally important to see that as those investments come to fruition and some of the early investments start paying off, you can see at the top left-hand side, the operating jaws of our business is getting positive. So last quarter, we had a 28% growth in operating income, and this is core operating income against a 14% gross growth. So we delivered a 14% jaw, which is a meaningful improvement from where we were. On cost to income, you're seeing the income levels uptick, and therefore the cost to income is also declining over a period of time. Broadly, we have been disciplined about our execution on our articulated strategy, and that's something that we've stayed through the last 3 years. And what did we say structurally and where we are today? We structurally said our NIMs would be in the 3.7, 3.8 range. At the end of quarter 2, we are at 3.96. We believe that cost of deposits will increase in quarter 4 and beyond for the system, which includes us. But we have cushions through structural improvements available for us to offset. So the pulls and pushes is what will play through the final number. Visible ROE is something I had called out about 10 quarters ago. We said we have visibility of 16, 16 and a half. Those days we were reporting ROEs in the 6 to 8% range. We've demonstrated the fact that we've delivered visible ROE for 3 quarters plus on a consistent basis. The aspirational ROE continues to be 18%. Last quarter's delivery was 18.9. Our growth aspiration was to grow the loan book at 400 to 600 basis points better than industry. We have done 300 basis points better than industry for quarter 2. Our focus segments have grown meaningfully faster than that number. And we still remain confident that over the medium term, we will deliver to this objective. Cost to assets, you've seen where the investments have gone. You've seen the quality of investments through the course of the day. Cost to assets stays at 2.25 today, but our confidence of getting it down to 2% over the next 2 financial years, which is FY25 exit, continues to remain strong. And that's what you would see us deliver to. You've seen delivery against the first 2 variables and the third variable. We have confidence that we can deliver the cost to assets journey. I'll pause there and I'll invite Amitabh for closing comments.